Hi guys, welcome to week 12. Now this is our last lecture and it's a pretty fitting one because what this one looks at is how we value a business, and in regard how we value the goodwill or the good name of the business, because this is probably something we would consider if we were looking to sell the business. Okay, we have to know how much we could sell it for. So let's get started. Let me just share my screen and then we can get started. So like I said, we're looking at week 12, okay, in our course, and we're looking at the valuation of goodwill. As I said, this becomes important when we're looking to sell our business, okay? We've made our money, or we've put our effort in, we've made it a popular business, and then we need to sell it, okay? So with that in mind, we then have to have a look at a couple of things. All right, so valuation. Value means different things to different people, okay? And as it says there, beauty is in the eye of the beholder, as the saying goes, okay? So true value is an abstract kind of thing. It's something that makes us happy, okay? So if we get more enjoyment from something than the suffering imposed through paying its price, we receive value. So if we get more enjoyment than what we paid for it, we might say that we received value. So if we feel that the enjoyment is worth $10 and we paid $5, we've received some value, okay? If we acquire things too cheaply and without much sacrifice, we usually take it for granted and there's little appreciation of its value. Another important thing when you consider value, the value that one person gives an item could be completely different from the value that another person gives an item. So what do I mean by that? Well, if you're in a flood and someone gave you 2 liters of water, you might think, well, that has no value to me. It's something I've got to carry and it could get washed away anyhow. But if you're on a deserted island with no water and someone gave you 2 liters of water, that would hold much greater value for you. All right. So usually we appreciate more the things we acquired through hard toil, okay? However, if we opened our eyes and looked around, many of the tangible things nature provide are for free, okay? For example, the air, water are more precious than the tangibles we buy with our labor. For example, your good health is more important than your wealth, okay? And as I said earlier, you can only estimate what a thing is worth to you. You cannot put an exact money measure on value, okay? So where does this take us? Often the biggest headaches in accounting are caused by incorrect estimates of the value of intangibles such as goodwill, brands, mastheads, those type of things. The other important thing is that you might be looking to sell your business. The value that you give the goodwill and therefore you give the business may not be consistent with what other people give the business and are looking to pay to purchase your business, okay? You can have 2 different views there, okay? 2 different views. Now, although business runs on self-interest and it's not tickled by benevolence, okay, there's a bit of a quote here and it says, I'll read the whole quote. Although business runs on self-interest and it is often not tickled by benevolence, as precious as gold dust is, when it gets in your eyes, it can obstruct your vision. So you've got to be careful that you look at these things with an open mind, okay, fully understanding what the circumstances dictate. All right, so the first thing we need to talk about is goodwill. So goodwill can be described as a benefit acquired by a business beyond its stock, capital, and property. So we might have a value of a business of $1 million, but the fair value of the net assets might only be 500,000. Where does the other 500,000 come from? It comes from goodwill. And that relates to the patronage it receives from its customers, i.e. the probability that old customers will come back, or as it says there, resort to the old place. So the goodwill is the market value of a business less the monetary value or the market value of its net assets. So you think about your favorite coffee shop. You might see two coffee shops located next door to each other. One full of customers, people waiting 15 minutes to get their coffee. The one next to that, no customers at all, even though there's a long lineup next door. That can be because the one that has the long lineup, they've been able to develop goodwill. How does that happen? Well, maybe they might greet their customers, and so people are happy to be greeted by their name, or they remember the coffees that the regulars purchase, okay, and people feel good about that. Or maybe they just take care in producing the coffee or have good prices, so they've built up a loyal following, okay, and that's our goodwill. So goodwill is the difference between the going concern value of the firm and its liquidation value. So the implication is that goodwill only has a value if it can be transferred for money, for consideration, okay? Logically, therefore, the personal knowledge and skill of the owner leaving a business has no goodwill value, okay? So the value of goodwill is centered on the earnings potential of a business. Now, how many times have you been to a coffee shop and it's fantastic? The owner knows you, the staff are great, coffee's good, and then the owner leaves and it changes hands and you get a new group of owners in, and all of a sudden it's not as good, because really in that case maybe a lot of the goodwill resided with the owner. He got the workers to work the way he wanted them to. He got them to make the coffee the way he wanted them to. He directed them. They liked working there. It was a good environment. New owners come in. The old owner and his personal goodwill have left, and so the business may even fail because of that. Okay, so let's have a look. An investor has the opportunity to purchase a McDonald's franchise in either the CBD of a major city or a small regional town which is not located on a major highway. The question becomes, which would you expect to cost more? Well, we'd probably find that the one in the CBD. Why? Because it would generate more profit, because it would have more customers. Okay, let's have a look at the next question. An investor has the opportunity to purchase either a McDonald's franchise which generates net profit of $500,000 per annum, or an unbranded hamburger outlet which generates net profits of $500,000 per annum. Which business would you expect to cost more? Now that's a little bit harder, isn't it? Because you would say that potentially there's two factors here. The brand name of McDonald's is an intangible asset, and that creates its own goodwill because everyone recognizes it. But the unbranded hamburger outlet, it may have a different type of goodwill because people just really enjoy going there because they've been going there for a lot of years and they know it produces a fantastic hamburger. So that one's a little bit harder to work out which path we should go for, okay? Which one might be more beneficial. Let's have a look at the next thing. An investor has the opportunity to purchase either a cafe that has traded for 10 years and generated annual profit of $400,000, or a cafe that's traded for 12 months and generated a profit of $500,000. Which business would you expect to cost more? Well, part of the issue here is how they value the businesses, okay? And we're going to talk about that a little bit later because there's a bit of a problem here. 10 years, annual profit, 400,000. It's obviously built up a lot of goodwill. It's still making good profit after many years. This one's only been running for 12 months. How do we know that it's not going to be popular for the first 12 months? And then people are just going to go back to their regular haunt because you know what? The cafe wasn't really as good as they said it was, or the owner lost enthusiasm after the first 12 months and the product offered was not really that great. Okay, so these are the things that we would have to consider. Okay, so the valuation of an intangible asset can be determined by either future profitability or the likelihood of obtaining a level of future profitability. Okay, so let's have a look at how we can work out goodwill. So those two factors may be expressed mathematically as goodwill being the future maintainable profits. So that's the expected profits in the future divided by a capitalization rate. Sometimes the capitalization rate may be an industry average, okay, or maybe just the going rate, so to speak, within that market. So a seafood takeaway store has estimated its future maintainable earnings as $200,000. The industry capitalization rate for similar businesses is 40%. Therefore, the value of the goodwill is $500,000. Now, you'll often see a couple of things here. So 1 divided by 0.4 is going to be 2.5. Okay. So sometimes when they talk about how much this business is worth, they'll say it's for sale at 500,000 plus stock, which is the assets and whatnot. And then in terms of, they'll say it's 2.5 times maintainable earnings rather than that 40%. It's still the same answer, but it's just a different way of expressing it. In determining future maintainable profits, several adjustments to reported profit will typically need to be made. So we've got our net profit. We're going to add back those one-off expenses that we don't expect to see in the future. So add back that to increase our profit. And we're going to add revenue that may not have been reflected, but we expect it to be going forward. We've got to take away non-recurring revenue. So it's a one-off piece of revenue. That's not going to happen in the future. So we take that away, and then we have to also take away any expenses that we might expect to have in the future, such as maybe some new government costs or council fees or something like that. And that's going to give us our future maintainable earnings. So, like I said, the first step is to add back all non-recurring expenses, such as excessive bad debts. Maybe there was some abnormal repairs or maintenance or excessive write-downs of some old assets. You add that back, okay? So a restaurant has disclosed a net profit of $300,000. This includes the following expenses: impairment of previously purchased goodwill, so that would be a one-off; loss on disposal of furniture, one-off; repairs to the restaurant, which are routine, so that would expect we would see them quite often; repairs to the restaurant following uninsured flooding, that's probably going to be a one-off as well. So let's see how we account for that. So our profit, we're going to add back that goodwill write-down, we're going to add back the loss on disposal, and we're going to add back the repairs, because really without those items, we would have had a profit of $384,000. We're not adding back the 14 because that's expected to continue in the future, okay? So we don't adjust for that particular item. We have to add back all additional recurring income. Okay, so additional income that may be expected upon the transfer of ownership, income from new contracts or agreements that not yet been reflected in the financial reports. You might have a new contract starting at the start of the new financial year, which is when ownership is going to be transferred. So a sports management business has disclosed a net profit of $420,000. The business has recently signed Cougar Waters, a leading international golfer who's expected to generate an additional $350,000 of commission for the business. The business has also signed a contract to promote the Senators 2011 Senators golf event in Melbourne. This will produce an additional $275,000 of profit for the company during 2010, 2011. Now, this is a little bit tricky how we account for this. Obviously, this golfer is going to produce $350,000 annually, okay, for a number of years. So that would be included. But we may not include the 275 because that's just a one-off event and it's not maintainable. It's not going to continue on into the future. So that's how we would come up with it there, okay? We then need to subtract all the recurring expenditure. Additional leases that have only been recently commenced, maybe additional personnel costs, maybe the depreciation on equipment that hasn't yet been put into service, so it hasn't yet been depreciated, but it will be going forward, all those sort of things. So a business is provided to provide cleaning services to Sydney Stadium. It generates $275,000. The net profit does not include a charge for equipment lease, as a related company has provided cleaning equipment at no cost. The market rate of leasing the necessary equipment is $80,000 per annum. So what they're saying is that with change in ownership, the new owner is going to have to lease equipment, and that leased equipment is going to cost them $80,000 per annum. So we would have to take that away from the profit, okay? The owner of the business has worked in and managed the business. It is estimated that it will be necessary to pay a manager a salary of $90,000 to perform the same function. So that's another cost that's expected to be ongoing, okay? It is expected that the purchase of the business will need to make a non-recurring payment. Well, straight away, because it's non-recurring, we don't have to worry too much about that, okay? Because we're only looking at those recurring events. So our net profit, when looking at future maintainable earnings, we're now going to have to lease the equipment in the future. So that's going to reduce our profit, and we're going to have to pay the manager's salary in the future. And that's also going to reduce our profit. So the future maintainable earnings is a very different figure, as you can see here. Now, why are we teaching you this? Well, we're teaching you this because in small business, and that's what a lot of sports businesses are, we often see entities buy and sell their business. Some people almost specialize in starting a business, building it up, selling it, and then doing the same again, whether it's a gym or a cafe or a sports store or some sort of fitness business, anything like that. And the reason we want you to understand this is that often you'll see an ad and it will just see profit times 3 for the cost of the business. But what we're trying to teach you here is that you don't just accept that profit figure. You've got to go in and look at that profit figure and find out what items are maintainable, what items, say, of revenue aren't maintainable, and what's missing that should be included in that calculation. Because it might mean that you pay a very different price if you can go through that analysis, okay? We then need to subtract all non-recurring income. Say maybe there was a grant from government, a one-off grant to build up a program for special needs kids in the area. So basketball club is available for sale. The club derives a profit of $480 after including the following income: grant from government towards building the new grandstand, gate takings, and advertising from a major sponsor. Okay. It's expected the new sponsor will sign with the club and provide $450,000 of support. So what's happened here? That's a one-off. We don't expect to receive the 330 into the future, and we expect the advertising to fall by 150 into the future. So that's going to be maintainable. So what we would do, there's our profit. We're going to take away the grant, and we're going to take away the difference in sponsorship, and we actually find that the future maintainable earnings is equal to 0. Okay. The capitalization rate, how do we work that out? Well, it's not so easy. Other businesses within the industry, assessed risk of the business continuing to attain the calculated level of maintainable profit. So what does this mean? Other similar businesses, you'd look at what the industry average is, because a lot of industries do have that, and you might use that as your capitalization rate, although you may adjust it, because if the risk of being able to generate those maintainable profits is actually quite high, you need to increase the capitalization rate. Whereas if the risk of maintaining them is quite low, you might actually decrease the capitalization rate. So what you might find is that if you believe that you can, so what I'm saying there, if you know that you can maintain those profits in this business into the future, you're prepared to pay more than if there's a risk that you won't be able to maintain those profits into the future. Okay. Where future maintainable earnings are unable to be calculated with any degree of reliability, it might be simply useful to isolate various components of an entity's intangible assets and maybe value them potentially. The problem you're going to have is that you're trying to value goodwill, and under the accounting rules, you can only recognize goodwill when you've purchased it from another company. If this particular owner has built this business up from scratch, they're going to have what we call internally generated goodwill. And internally generated goodwill can't be recorded in the financial statements. So what we're trying to do with this process is work out how much that internally generated goodwill is really worth to someone purchasing it. It's a couple of things here, guys, you've got to be careful about. You might purchase another business because it's built up a good reputation, but it might have built up the reputation on the previous owner. You may not be able to replicate that. There may also be the case that the business has grown, it's had good earnings, but it's in the decline phase, and it's expected that the business won't be as popular as it once was. Think about like businesses like Video Easy and Blockbuster. They had huge amounts to buy and sell their franchises when the businesses were profitable, but eventually there was a decline, and you've got to be careful that you're not buying at the peak, is what I'm trying to say. Okay. All right, guys. So we'll leave it there. That's our last lecture. Please make sure that you have a look at the tutorial. I think you'll find it is really beneficial for your understanding. If you have any questions, don't forget, you can always contact me. Okay. And I will get back to you as soon as I can. Okay. Thanks, guys. Have a great day.